you're going to go live today. You're going to work today. Hey, there we are. We're on Facebook and we are live. Isn't that amazing how sometimes it just actually works? So, hey, we're on here and it is Friday, October. What is it today? 16th. It's been a crazy week. And as I go through these gyrations that I go through, it is a learning experience for this 71-year-old kid that is excited and enthusiastic about the message that he has and what he has discovered in the last 20 years or so, after 44 years of being in this financial services industry, to find myself today with what I believe is the answer to real financial opportunity in the future. As we start every day and every meeting, I want to start out today talking about and passing out prayers for everybody that's been impacted in one way or another by the COVID stuff going on. I'm an hour late. I'm usually on here at noon, but it's now 5 to 1. But we're going to get it done, and it'll be on here for everybody to watch. I know sometimes I have people that are on here that are watching, and sometimes I just don't have people that are on here watching. So I'm going to move some things around, and so I know where I'm at here and going for it. So with that, our heartfelt prayers go out to everybody in America, everybody in the world, because everybody has been impacted by this COVID-19 stuff. It is now getting ridiculous. There is this so-called second wave starting to happen. So I don't know where it's going to go, but I do know that we will get past it and we will get this behind us sooner or later. Our prayers also go out for the loved ones who have been lost and those who have lost loved ones. So our heartfelt prayers go out to everybody. So with that, we've talked this week about the Daddy Bank. And I want to try to create today a bigger picture. I made a bunch of notes and things that I've got laying here, but the things I want to cover today. But again, let's talk about the rules, the banking rules. I want all your money more ongoing, keep forever, give back as little as possible. That maximizes their financial well-being and their profits in the banks and the financial world and Wall Street. Let's look at our side of the table. And I want to save 20% of my gross annual income. I want to have 50% of my gross income in accessible cash. I want to have no consumer debt. Home mortgage is not consumer debt. You have to pay to sleep, whether you're renting or own a home or whatever. You are where you are. You've got to do that. Now I see the video has now stopped, and why I don't know. So we got another new challenge today. But I hope I'm on here live. And you know what I'm going to do? I'm going to take a minute, and we're going to take a quick minute. And something has really challenged here on what's going on. And it has stopped. So I'm going to switch cameras is what I'm going to do. And okay, so now we're in a different camera and we're going to keep going. So I think the camera that I was using, the battery in it probably just expired. I would think I heard it click, so I've got to change a battery in it. But anyway, we're going to keep going. Talking about Daddy Bank and what that really means for everybody. Because planning for the future, the 4 rules of the financial institution, you have to understand those. And when you make decisions about your money, your finances, your long-term future, you have to think about all of these basic rules. Remember, there are 5 elements: risk, taxes, regulation, inflation, and depreciation of the money. So every time we make a decision, are we solving one of those 5 elements, those 5 challenges: risk, taxes, regulation, inflation and depreciation of the dollar. In our example, we talked about a 25-year projection ahead, and the Joyce lady was going to have $1,435,000, and inflation cut it in half. $1 in 25 years is only worth 47 cents at 3% inflation. If you believe that and believe the government, excuse me, I'm gonna shut that switch off over there. So we got that camera shut off. So when I'm planning, there are more elements. There is opportunity cost in some things I do. When I have investment accounts, I pay a fee in a lot of those accounts. And every dollar of that fee has opportunity cost associated with it. So we're going to deal with opportunity cost related to fees and costs. So as we do things, the example is buying a car. So you pay $25,000 for a car, you finance it at 8% for 60 months, and at the end of that 60 months, you paid $5,400 in interest to the bank. That's gone forever. It's never coming back. But not only is that dollar gone for the remainder of your life, what about the interest it would have earned, assuming it were invested earning 8%? Well, over a 40-year span of time, it would be worth $253,000. So that $5,400 that you paid to finance that car could have a value of $253,000 at your retirement time. Assuming you were 25 years old when you got out of college, you bought this first car, and at retirement, you've now kissed off $253,000. That is how important it is to understand family banking, the family money farm, keeping the money on the farm in the family. And all the family members have to be taught how to do this. They also have to accept the responsibility of discipline. You know, because if they don't make payments, then they don't get to participate in the bank anymore. And they don't get to inherit, ultimately, what is created in the banking for the family bank. Now, you buy another car in 5 years and another car in 5 years. So you do the typical thing that most people do, and every 5 years you finance another car. Well, the total amount of interest and opportunity cost at retirement is now $770,000. Who wouldn't want another $770,000 at retirement time in your bank account? Who wouldn't? You know, are you one of those people that you're just resigned to the fact that you're going to be one of those acceptable level of mediocrity people? Is that where you're at? Because without listening to what I'm telling you, what I'm showing you, what I'm teaching you, you're going to lose millions of dollars. There was an article, and I thought I grabbed it on my desk. Yeah, here it is. Here's an article right here. You know, when people get to retirement, they think about, I'm sorry. They want to take their Social Security at age 62. Well, from age 62 to your full retirement date, it increases at 6% per year plus inflationary increases. From your full retirement date to age 70, it increases at 8% per year plus the inflation rate. I turned 71 in September. I got Social Security last year. Now I got an 8% increase in that last year of waiting, plus I got a 2.5% inflation increase. So I picked up a 10.5% increase in my retirement, in my Social Security benefit. I don't know how you could duplicate that without a tremendous amount of risk, even if you could actually get it. So here's some statistics. I get this newsletter from Mark Zinder. It says here, at age 62, the most popular age to claim Social Security, with nearly 40% of men and nearly 35% of women claiming benefits as soon as possible. The study estimates that today's older Americans will lose a total of 3.4 million, 3.4 trillion, I'm sorry, 3.4 trillion in potential income because of early claiming, with an average lifetime loss of $95,000 per household. Now, how do I wait for my Social Security? Well, you have to have savings. So you have to be able to buy that income for that slot of time. So if I'm getting $3,000 a month income, $36,000 a year for Social Security, using that as a number. And I look at that and I say, okay, I'm 67 years old. I have 3 years. So I would need 3 years or $108,000 in savings elsewhere so that I could buy that Social Security for myself, pay myself the equivalent for the 3 years, and then apply for Social Security and get the increase. So if the Social Security is $36,000 a year times 8% plus equals times 8% plus equals times 8% plus equals. So now at 70, my income without inflation would be now $45,000, not 36,000. That there is tremendous wealth that people lose because they haven't planned properly. You know, the average mom and pop, which has been most of my business my entire life. You know, I have some business people and some professionals that are clients today, but the majority of my clients have always been gray collar or blue collar people. And my heart goes out because they are brainwashed into thinking a typical way. The advertising and marketing that surrounds us every day programs our thinking, and it prevents us from thinking correctly. And without thinking correctly, you don't see the opportunity that lays in front of you. Again, you know, 30 years ago, I was at the depth of the bottom of the pit on the edge of going bankrupt. When I met a guy named Jody Victor, he took my hand and he said, "Is this what you want?" And I said, "No." He says, "Well, take my hand, I'll help you fix it." And what I have learned in the last 30 years in crawling back from the edge of destruction, paying all those bills off, and getting to where I am today, I'm not where I want to be, but I'm surely not where I would have been if I'd have stayed on the track that I was on 29 years ago. That's all I'm trying to do, folks, is to share those experiences with you and add mathematical proof. That's the great thing that, you know, 20 years ago, I met a couple people and it literally changed my life because it put me on a path of learning how to have proof of what I'm doing. And that gave me more confidence than any time in my life. And it allowed me to dig my way back out of the hole that I was in. And it led me to write the book I wrote in 2006, Life Insurance Will It Pay When I Die, because so many people were getting sucked into buying universal life insurance. And then it became variable universal life. Then it became now index universal life today. And people are still being sold the same dream that is going to evaporate unless you die soon. You know, if you're going to die early, I guess the universal life would be a good product. But if you're planning on living to life expectancy in your 80s, then the universal life insurance, because there is a term element in that contract, you're actually paying an annual renewable term insurance premium inside that contract alongside of the savings portion in that contract. So your savings actually get drained off to the insurance company, paying for the term insurance cost inside that contract. And you know, term insurance is the most profitable product in all of the insurance industry, because Penn State University study, 1993, look it up. Less than 1% of term life insurance ever ends in a death claim, which means 99% of all the premiums paid for term life insurance just become profit for the salesman in providing his commission and the operation and profits of the insurance company. Nobody ever told you that. I'm not negative about term insurance. Don't get me wrong. Younger couples, it's a way to have proper amounts of life insurance and cover economic human life value. We've had that discussion in the past, but it takes a portfolio of things. It isn't just one product that solves your problems. It takes a plan and multiple products with plans along the way on how those are going to be exchanged or interpreted or converted, or how that's all going to work. But we're always simply looking at how efficient can we be in what we're talking about. That's what it's about. I just finished reading this book, The Balance Point. It's an interesting book, and every chapter, and I'll read just some of the names of the chapters because they're unique in the way they present things, because they make you think. You know, work versus play, yes versus no, purpose versus passion, reactive versus proactive, intention versus perception, consumption versus production, instant win versus delayed gratification. And that was where I ended up last night. The next one is hustle and health. But the delayed gratification, you know, the win early or delayed gratification. The biggest challenge that I had in my life was truly grasping delayed gratification, because I wanted it now. Growing up, we never had anything. My dad had 8th grade education, never made a lot of money, always worked 2 and 3 jobs, piddly jobs that made pennies. And I remember on payday, my father would come home and he'd throw $3 on the table for my mother to buy groceries. And there would be an argument. When I got old enough, I just wasn't there on that day because I knew what was going to happen. My dad was a stickler at paying his bills. But he worked hard. Hard work isn't what makes you financially secure. It takes some smart thinking in addition to. So that's really what it's about. You know, the Daddy Farm, we did this little talk. I explained, you know, the Daddy Bank the other day, and the Daddy Bank was really kind of easy to understand. You know, Dad, he has saved all of his life and he had a substantial amount of money. He had $500,000. And he wanted to make 10% rate of return on that money. So how could he create a plan? He had 2 children that were both grown up and adults. So he took his $500,000 and he built 2 brand new homes for his 2 children, with the agreement that they paid him $2,000 a month, each of them, $2,000 a month, for all the expenses of operating those houses. So $2,000 a month, that's 24 and 24, that's $48,000 a year. So that was his 10% rate of return. But then he took the money that the kids paid him. He didn't really need the income. And he took that and purchased a permanent dividend paying, cash value life insurance policy on himself because it was very likely he was going to die and graduate this earth before his kids would. And that $50,000 a year in premium bought a policy that was a couple of $1 million in size. And along the way, the premiums, when they were paid in, created cash value. And the cash value could be leveraged with the insurance company and used to buy automobiles or make capital purchases, et cetera, between that time and when father passed away. So it provided the money to buy things without, it eliminated the commercial banking, which is what I have done in my life. I don't want anything to do. I love them. I have checking accounts there. We need them and their services, but I don't want to be a servant to their system. Do you? Do you understand the question that I'm posing to you? You know, the banking concept. You need to get Nelson's book, The Infinite Banking Concept. How do I do that? Well, you can email me. I have them. They're $20 plus tax and shipping. Or you can go to cfo-project.com, get a copy of my new book, The Family Money Farm, the CFO Project, and then you will get to another page that will recommend that you invest $47. And you'll get 4 books over there. You'll get part 1 of Nelson's book, Live Your Life Insurance, Life Insurance Will It Pay When I Die, and Jumpstart Your Financial Freedom, and a 1-hour video that will change your life. Comes with a money back guarantee. If you can tell me you've read the books and you've watched the video and they did not have a positive impact on you or value, then I will write you a $47 check back. It's just that simple. This isn't about selling you something. It's about providing value that has the potential to literally change your future. That's what it's about. And ultimately, when in the daddy bank, when the 2 children inherit what daddy created, there's no tax. The houses pass on a stepped up basis, so there's no taxes in the homes being transferred to the 2 children. The death benefit on the life insurance policy is paid absolutely tax-free. In Pennsylvania, there's not even any state inheritance transfer tax on a death benefit in Pennsylvania. So it's starting to understand that all of these different things that you can do, it's going to take some thinking and some learning. You know, I have another program when I sit down with people and I look at what they've already got and I say, okay, what do you want? And let's sit down and write out the things that you want. And then let's evaluate what you have and what you're saving. And let's see if it's going to get you what you really want. And more often than not, it won't. It won't. It's just not, it's not there. Nobody ever looked at it the way that I help you look at it. It's not me telling you what to do. It's me showing you a better way to see what you're already doing and where it's going to take you. I think that's important. I'm going to cut it off there today. We're 20 minutes out. We'll be back next week. We're going to do some unique things next week. I'm going to bring out a couple of books because I want to get inside your head and talk about the why. You know, we're going to talk about the dead clock next week and what's going on around us right now, because this is scary stuff that's happening, and it's not just the COVID. And I guess what I heard on the news is they've now agreed to spend another $1.75 trillion or whatever in more money to prevent the collapse of the economy further. I don't know how much more they can print and borrow. And in doing that, it's only going to accelerate the appearance of what I believe is some dark times in the future that are coming financially. And I believe the only way that you will survive well in the coming dark time of the money, when things start to really get crazy, is to be out of debt, have control of your money, and have savings. I don't know any other way to survive this coming financial dark cloud that now sits over top of Washington, and it will eventually disseminate everywhere and affect everybody like this COVID. It'll be like a new plague. So anyway, God bless. We'll see you Monday, 12 o'clock noon. We're going to try to be on time next week and get this done and get it done properly. So, hey, God bless. We'll see you next week.